What if I told you the $84 silver price on your screen is the biggest bear trap in 46 years? While retail investors are still paralyzed by the crash from $121 down to $64, the people who actually move the metal, the vault managers and refiners, are watching a liquidity vacuum that is about to snap shut. We just saw the worst single-day drop since 1980, yet 26% of COMEX inventory vanished in the same week. If you're waiting for lower prices while the paper-to-physical ratio sits at 356 to 1, you aren't just missing a dip, you're being played by the banks. Here is the data the Warsh shock was meant to hide from you. Sunday, February 22nd, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. Because right now, while most people are still trying to figure out what happened over the last 3 weeks, the smart money is quietly positioning for something massive. And if you are not paying attention to this setup, you could be leaving one of the biggest opportunities of 2026 sitting right on the table. Let me take you back to January 29th, 2026. Silver hits $121.64 per ounce, an all-time high. A number that nobody, and I mean nobody, had penciled in for Q1 of this year. The metal was on an absolute tear, momentum was building, headlines were starting to catch fire, and then, almost overnight, everything fell apart. Within days, not weeks, days, silver collapsed 43%. From $121 down to a terrifying low of $64.08. That is the kind of move that wipes out leveraged positions, triggers margin calls across the board, and sends retail investors running for the exits, screaming that the silver rally is over. But here is what most people missed completely. Silver did not stay down. Right now, as of February 20th, 2026, silver is sitting at $84.37 per ounce. It clawed back above $80. It held. And that recovery is telling you something incredibly important if you know how to read it. So what actually caused the crash? Let me explain this simply because this is where it gets really interesting. The trigger was something the market is now calling the Warsh shock. Kevin Warsh, a name you need to know, was nominated to replace Jerome Powell as the next chair of the Federal Reserve. Now, Warsh is known as a hawk. That means he leans toward keeping interest rates higher for longer, being tighter on monetary policy, and being far less sympathetic to the kind of easy money environment that sends non-yielding assets like silver through the roof. The moment that nomination hit the wires, futures traders panicked. Silver suffered its single worst day since 1980. Let that sink in. 46 years. The worst single-day crash in nearly half a century, triggered by one personnel announcement. That is how sensitive this market is right now, and that sensitivity cuts both ways. Because here is the thing about that crash that nobody in the mainstream financial media is giving enough airtime to. When prices collapse that fast and that hard, something else happens in the background. Short sellers pile in. Traders who bet on prices going down saw that crash and thought the party was over for silver bulls. They loaded up on short positions near the bottom, expecting silver to keep falling, expecting $64 to become $50, expecting the all-time high to be dismissed as a one-off speculative blow-off. And now? Silver is back above $84. Those short positions are underwater, and the market is sitting on an absolute powder keg. This is the short squeeze setup that nobody is talking about. When a market has a massive concentration of short positions, and the underlying fundamentals are screaming in the opposite direction, what you get is a feedback loop. Prices start moving up, shorts start feeling pain, they cover their positions by buying. That buying pushes prices higher, more shorts panic and cover, and suddenly you have a self-reinforcing move that can travel incredibly fast. We have seen it happen in other markets. We have seen it happen in silver before, and right now, the conditions for it are arguably better than they have been in years. Let me give you the fundamental picture because this is where the real story lives. Silver is not just a shiny metal that people put in their portfolios as a hedge. More than 60% of all silver demand globally is industrial. This is not gold. Gold sits in vaults. Silver goes to work. It goes into solar panels, into semiconductors, into electronics, into the infrastructure of the modern economy. And here is the number that should genuinely shock you. Solar panels alone now consume nearly 30% of all industrial silver demand. The green energy transition is not slowing down, it is accelerating. Every solar farm built, every rooftop panel installed, every utility-scale project commissioned requires silver. There is no substitute. The physics demand. And now layer on top of that something that is only just beginning to register with retail investors. AI data centers. Semiconductor manufacturing for artificial intelligence chips. These are emerging as a powerful new demand vector for silver that was not even part of the conversation 2 or 3 years ago. The build-out of AI infrastructure is happening at a pace that is difficult to comprehend, and silver is embedded in that supply chain at a fundamental level. So when people say silver is just a speculative trade, they are ignoring the structural demand story that is quietly building underneath the price. Now combine that demand picture with what has been happening on the supply side, and you start to understand why the short sellers are playing a genuinely dangerous game. Since 2021, the silver market has been running a continuous deficit. Supply cannot keep up with demand. From 2021 through 2025, the cumulative shortfall has reached 820 million ounces. That is not a rounding error. That is a structural imbalance that has been eating through above-ground inventories year after year after year. And the projection for 2026? Another 200 million ounce deficit in a single year. So while the shorts are betting on silver going lower, the physical market is screaming that there is not enough of it to go around. Treasury Secretary Scott Bessent came out and called the January spike a speculative blow-off driven by Chinese traders. And look, there was absolutely speculative activity in this market. Nobody is denying that. But calling the entire move speculative and blaming Chinese positioning conveniently ignores the 820 million ounce supply hole sitting underneath the price. You can dismiss the froth. You cannot dismiss the fundamentals. And the fundamentals have not changed because the price dropped. Now let me talk about the macro environment because this is the third leg of the bull case and it is strengthening by the week. The Federal Reserve is expected to cut interest rates twice in 2026. Markets are currently pricing in roughly 60 basis points of easing by year-end. Think about what that means for silver. When rates fall, the opportunity cost of holding a non-yielding asset like silver drops. Money flows out of cash, out of bonds with shrinking yields, and into assets that hold real value. We already saw weaker data coming out of the US. December retail sales stalled when the market expected growth, and the GDP control group actually fell 0.1%. Inflation is showing signs of cooling. The data is building a picture of an economy that needs easier monetary conditions, and easier monetary conditions are rocket fuel for precious metals. This is not a one-factor story. You have supply deficits, you have industrial demand accelerating, you have macro tailwinds from a rate-cutting Fed, and you have a pile of short positions sitting on top of all of it waiting to be squeezed. Every one of these elements is pointing in the same direction. And then there is the wild card that JP Morgan's head of base and precious metals strategy, Greg Shearer, specifically flagged: tariffs. If Section 232 tariffs on silver are reimposed, what happens is physical metal gets pulled back toward New York. That tightens global liquidity in the silver market almost instantly. When physical silver becomes harder to source in key trading hubs, prices move, and they move fast. This is a tail risk that is not fully priced in, and it could be the match that lights the fuse. Now let me give you the analyst targets so you understand the range of outcomes that serious institutions are actually modeling. Citigroup has put out a 3-month price target of $150 per ounce. TD Securities sees silver reaching $118 at its 2026 high. And gold-silver analyst Alan Hibbard has made the case for $175 or higher before the year is out. Are these guaranteed? Absolutely not. Nobody can guarantee price targets in a market this volatile. But when multiple major institutions are independently modeling outcomes in the $100 to $175 range, it tells you something important about where the weight of institutional thinking sits right now. So what happens next? Let me give you 3 realistic scenarios and you can decide which one you think is most likely. The first scenario is continued consolidation. Silver grinds sideways in the $80 to $85 range for the next few weeks. Short sellers hold their nerve, no major catalyst appears, and the market digests the recent volatility before its next directional move. This is the patient scenario. It does not mean the bull case is dead. It just means the market needs more time. The second scenario is a gradual grind higher. The upcoming January jobs report comes in weak. CPI data shows inflation cooling faster than expected. The Fed signals it is leaning toward cutting sooner rather than later. In this environment, silver starts reclaiming ground steadily, $90, $95, $100, not in a single explosive day, but over weeks as the macro picture shifts and institutional buyers step in. This is the orderly bull case, and it is arguably the most probable outcome if the data cooperates. The third scenario is the one that keeps short sellers awake at night. A major catalyst hits, whether it is a surprise Fed statement, a tariff announcement, a dramatic miss in the jobs data, or simply the weight of short covering hitting a thin market at the wrong moment, and silver goes. Not gradually, fast. Back toward $100, through it, and potentially back into the territory where we saw those all-time highs. A short squeeze of that magnitude in a market with this much fundamental support underneath it is not a fantasy. It has happened before. The setup for it exists right now, and the people who are positioned before it happens are the ones who end up talking about it for years. The January crash shook out the weak hands. It reset sentiment. It allowed short sellers to build positions that are now sitting in a fundamentally dangerous place. Silver is above $80, holding its ground with 820 million ounces of cumulative deficit at its back, solar and AI demand growing in front of it, and 2 Fed rate cuts on the horizon. The biggest short squeeze nobody is talking about may already be loading. Watch the jobs report. Watch the CPI print. Watch every word that comes out of the Federal Reserve. Because in this market, one piece of data could be the trigger that changes everything. Now I want to hear from you. Where do you think silver goes from here? $100? $150? Or do you think the shorts are right and we see lower levels first? Drop your price prediction in the comments right now. If you are new here, subscribe. This channel covers the moves that matter before they happen. Share this video with anyone who is watching silver or thinking about it, because this is the analysis they need to see. And if you made it this far, you already know more about what is happening in the silver market right now than 99% of investors out there. Stay sharp, stay informed, and I will see you in the next one.